Welcome to our first Switzer TV property show. I'm Peter Switzer. Every Tuesday night we'll examine the big real estate issues, tell you where to buy and when to buy, and using some of the biggest names in Australian property. I want everyone to think, before they buy property, go to Switzer. On tonight's show, will the 40% house price drop guy, Martin North, give up on his Armageddon forecast? Century 21's founder, Charles Tarbey, tells us where to buy right now, and CoreLogic's Cameron Kusher gives us the heads up on house prices right around the country. Martin North from Digital Finance Analytics, thanks for joining us on Switzer.
Hello, Peter. How are you?
Very good, mate. Now, you know, I can't run away from the question. I have to start off with this. You once predicted a 40% fall in house prices. What's happened to that? And is it something that might come again?
Yeah, it's a good question, Peter. And look, you know, the headline, of course, always belays the detail, which is that there were a number of different scenarios that I always ran.
Yep.
And the 40% fall was predicated on a global crash and that then coming over the top and basically hitting Australia. Frankly, that is still one of my scenarios. And if you look at what's happening with the trade issues with China and the US, if you look at Brexit, if you look at the slowdown in China, I mean, there's a whole long litany of things that I could talk to in terms of, in the worst case, that is still out there. The question, of course, how likely is it? And, you know, 70% of economists in the US are still predicting a recession next year in the US. So that is still a live scenario. It's not the only scenario that I've run. And at the other end, you know, if in fact the RBA is right, and if in fact we don't get any of that international disruption, then I've said and continue to say that there's still some potential upside for property prices. Not a lot, but a little. And I suspect the truth lies somewhere in between those 2 points, insofar that there are a number of local negative indicators with regard to the economy. And some of those are actually going counter to the recent news in terms of home price movements.
Were you surprised, and I've got to say, I am surprised how quickly the recovery has been in both Sydney and Melbourne in auctions and, as we've seen from CoreLogic today, house price rises as well. I thought that the scariness of the house price drop was such that buyers would be, you know, pretty worried for some time. Has this surprised you?
Well, it's quite interesting. Of course, the property market is not one market, right? It's a series of micro markets. And I think it's very important to understand that there are some quite dramatic changes and differences across different elements in the market. You know, to give you one example, if you look at houses in Cronulla, right, they're up 1.4% over the last 12 months. Units in the same postcode, they're down 8%, right? If you go to Miranda, they're down 13.6%, and the North Ryde, they're down 30%. So the point is, there are definitely things going on differently in different locations. My read of the situation is that there are quite a few people coming into the market buying houses, particularly close into the main urban centres in Sydney and Melbourne. Some of those got cashed up couple of years ago when effectively they sold before the price slides started. And some of those are people what I call up traders, so they're people buying up into the market. We also know that now as the spring season begins to start and we're going to see more people listing their properties, my research from my survey suggests that we're going to see more property investors still thinking of selling because there isn't the capital growth that they've seen before. And we also know that there are a lot of down traders, people with big properties looking to get out and release some equity who also want to list. So I think this is probably part of a bigger story, Peter, in terms of how this market is going to play out. But yeah, I think in some locations, prices have bounced more quickly than I expected. And I think we're going to see a little bit more of that. The question is this a bull trap or is this something more substantial?
And I guess the argument will be it is a bull trap if the worst case in a national economic scenario comes to visit upon our shores.
Well, that's the real dilemma, right? Because effectively, you know, if you look at the local economic data, you know, frankly, households are not spending, businesses are not investing. The iron ore price has slid back from 120 US to about 90. It's government spending that's supporting the local economy. The GDP number out later in the week will be, I think, a low one. So locally, we have a number of, you know, worrying issues. Construction jobs dropping, 100,000 probably by the end of the year, retail jobs dropping. So locally, we have a number of issues. But you're right. The question is, how significant are the risks from the international perspective? And I guess that has to come back to, is Donald Trump going to really take this to the wire up to the next election and therefore push the US into recession? Will the Fed be able to turn the taps the other way and basically postpone it or not? And, because if that happens, have no doubt, prices will fall.
Right, now, Martin, I've never got personal with you, but I will because, for the hell of it. If you had, I'm not sure what your family situation is, but if you had a daughter or son said to you, Dad, should I go looking for houses at the moment in Sydney and Melbourne? Because as you pointed out, some places are down a lot. Is this still a good time for the house hunter to show up to auctions and to look around for bargains?
Well, I think it depends on what type of buyer you are, Peter. If you are an owner-occupied person and wanting to get into the property market and you need one property, somewhere to live, and you can do it without stretching yourself too much on the mortgage, and you can understand that you might risk losing some capital by coming into the market at this stage, but because you want it for shelter, for somewhere to live, for your family, because you want to own a bit of Australia, it may be worthwhile thinking about it. If you're a property investor, I think it's much, much more tricky because, look, frankly, the property investment scenario that I'm looking at suggests that there really is not going to be the same significant capital growth that we had over the last decade, that the economic costs of owning investment properties have changed because the rental streams are a lot weaker than they were. And certainly I would not be buying a new high-rise or a new unit for investment purposes specifically now because, of course, the issues about construction and defects and all of those things too. So I think if you were an owner-occupier and you were buying for the first time and you could, justify without too much risk, it might be worth it. But look, the point I think we've got to come back to is this fundamental question. Is property fundamentally somewhere to live, or is it an investment class? Is it an investment asset, right? Because I think people have got so used to thinking of investment classes including property. And frankly, I'm just concerned that we may have lost the plot a bit. Property is somewhere to live predominantly, I think.
Okay, so one thing you've done, I think I first started noticing your work, was around mortgage stress. What's the latest readings you're getting on mortgage stress?
Yeah, the story is not good, I'm afraid, Peter. So we've got well over 1 million households who are registering in mortgage stress, and that basically means that the income coming in is not sufficient to cover all of the outgoing costs, including paying the mortgage. And unfortunately, the number are rising, and it started over in the West, in Western Australia. And for example, 2 years ago, there were a couple of postcodes over in the West that look really, really sick. Now, if you look at them today, they've gone even sicker. But I'm seeing some of those same trends now in some of the outer suburban areas in Sydney and Melbourne and in Brisbane. Also up in the Queensland area as well, particularly in the mining belt as well. So yeah, mortgage stress is real. And of course, if you look at mortgage defaults, which is the end outworking of mortgage stress, it probably takes 2 or 3 years to get to that. Defaults are higher than they've been for some time, higher in the West, but also now building in New South Wales and Victoria too. And the reason for that is quite simple. Big mortgages, incomes are flat in real terms, costs of living are rising, and many households don't have the amount of work that they would like. They're underemployed. And, my own sense on employment is it's going to weaken rather than actually strengthen. In other words, unemployment will rise, and that's going to put more pressure on households, more pressure on mortgage stress, and therefore more defaults.
Now, Martin, I know you've confessed to me in the past that you're not an economist, which is a badge of honour, I guess, in many areas. But the interesting thing about we economists, I know Steve Keener suffer the same problem, is that there can be structural changes in the economy going on. And every time I see your mortgage stress data, I go back to the 80s when I was living with 17.5% home loan interest rates. And I wonder whether you've investigated this, that whether some of the mortgage stress we see nowadays is because family spending patterns structurally have changed. Like, for example, in the old days, I watched TV, I didn't have to pay for TV. I didn't have credit cards the way I did. I didn't have a new car, I had a very old Tirana. I know mortgages are the main things we borrow, but are the other aspects of our life also making mortgage stress even worse because of the changing nature of the way we spend our money? And we didn't have mobile phone bills as well in those days.
Yeah, and data and net streaming and all the other stuff, right? No, you're right. There are definitely some differences now compared with 20 or 30 years ago. But, if you look at it carefully, the average proportion of income going to repay the mortgage for many people is still a lot higher than it was even way back then, right? And that is because the mortgage is a whole lot bigger than it was. And I know interest rates are very low, and that helps on the interest repayment front, but you still have to pay off the capital eventually as well. And what happens quite often is that when people get into mortgage stress initially, or when they get into financial difficulty, what they do is they reach for the credit card, and then they get 2 or 3 or 4 credit cards. And so their overall footprint of debt goes up. And I think that's the most significant structural change that I've seen, which is that the amount of debt in the system against those households are way higher than it's ever been before. Everybody quotes the 200% number, but remember that's the average of all households. Only 1/3 of those are borrowing. And those, the average debt to income ratio is about 6 times, which is remarkably high. And so that's a structural difference. The other structural difference, of course, is that previously people had an expectation that incomes would grow, more than just to cover the cost of inflation. But since 2008, according to the latest Hilda data and other data too, there's been no real increase for most households in terms of real income. So that's the other factor that's structurally very important. So how come we've got a situation where we've got more debt, where we've got flat incomes, where we've got households beginning to struggle? The unemployment rate is the critical thing. If it stays low, fine. But if it starts to rise, boy, that's going to be a big issue. Yeah,
the one last thing I'd like to throw at you, and I only got this data today, and I don't know whether you're across it, but wages increased 4.7% for the year, yet inflation was 1.7%. So I've got effectively a 3% increase in real wages. Does that surprise you, Martin?
I'm not sure. I haven't seen that particular number, Peter, but that's certainly not the data that I'm seeing out of the surveys that I run. I think the problem, of course, there is you've got to look public sector, private sector. You've got to look across different industries. There are many people now working in low-paid industries, for example, in healthcare, in the healthcare sector and places like that, who've actually had quite big increases, for example, in Victoria quite recently, because of a settlement that was put in there. But that was a bit of a one-off blip. So let's watch what happens. I mean, if incomes really do start to rise in real terms, well above inflation, then that changes the game, and maybe the RBA is right, and maybe we'll get to 4.5% employment and unemployment, and therefore maybe wages will really begin to take off. If that does, that will take the pressure off. That will then mean that home prices will rise. But I think it's a bit early to say for sure. Yeah.
Well, Martin, it's always good to see that you're not a one-trick pony, that everything you say is scary and Armageddonsville. I know for a fact that you do have alternative scenarios. I thank you for sharing them with me on the program tonight.
Good to talk to you, Peter. And as you say, I take a range of views. And by the way, I'm a philosopher by nature, not an economist, but that just makes me ask the why question, which is always a good one to ask.
Without a doubt. Martin North from Digital Finance Analytics, thanks for joining us. Well, we've seen house prices recover much more quickly than a lot of the experts thought. And even, I've got to say, even faster than I thought as well. To talk about this is a guy whose business is really at the coalface of Australian property prices, Charles Tarbey, the founder of Century 21. Charles, thanks for joining us.
Thank you, Peter.
So, well, you and I have talked about how we didn't believe the worst case scenarios that we had. But did you think the market would rebound as quickly as it has?
I felt that there was a rebound coming because the boom stopped too late. It should have stopped in 2017.
Yeah. And you were actually complaining that interest rates were too low and the boom were going too long.
And so people went that extra mile. And so I said to everybody that was buying around, so if you're going to buy something now, just remember, whatever you buy today will be worth what it was worth in 2017, because that's where I believe the prices should go back to, and then we'll have that steady climb. And I think we're very close to the mark. We certainly haven't had the 40 and 50% drops that some people have been claiming would occur.
All right, now, I've often teased you about your Western suburbs origins or roots, and and the thing I remember, particularly when we were doing the radio program, and you'd come in, once a week and talk about, and that was right in the heart of the boom. One thing that shocked me was, I think you revealed to us that the median house price in the Western suburbs had gone over $1 million. And that to me was, I thought this is crazy. Yeah, and even though I love the Western suburbs, that was a very high number.
Well, if you look in the lower Blue Mountains, for example, that's well and truly still the case. If you can find something there, like something that a person might want to buy as a second home, well, good luck. You're paying $1 million plus anywhere there.
Really?
And the reason that you talk about me in the Western suburbs, I was a bit frightened about coming here today because I had to cross George Street, and I believe the Western suburbs starts at George Street for Eastern suburbs.
Eastern suburbs people,
so it was a bit scary for me. And I still believe that those areas in the West will continue to grow because they've got the infrastructure happening. There's an intense focus on the west, southwest, northwest when it comes to infrastructure. So I do not see the Western suburbs being called the Western suburbs in inverted commas anymore.
But is that median price over $1 million now, or is it something it will work towards as this house price rise period?
Yeah, there's certainly properties you can buy in the 6s and 7s, and there's although there's not a lot of listings around, not in abundance, that's probably where the prices should sit. 6, 7, maybe 800,000, but certain pockets, it's definitely over $1 million.
Yeah, well, places like Strathfield, they've always
well,
been.
I mean, if you go further, if you go to the northwest sector of Sydney, the property prices there, if you have a look, there's not much for sale under $1 million.
Let's not be Sydney-centric, because you're a national company. What's happening in Melbourne?
The Melbourne Markets actually rebounded as well, which has been really interesting to watch. The clearance rates have been the one that we watch, and although the clearance rates don't represent the majority of sales that occur, they certainly give you a very, very good idea. And Melbourne was declining rapidly. It went through a terrible period, and now all of a sudden it's sitting back up into the 70s with 600-700 auctions going up on the weekend. This time last year, you would have seen the auction clearance rates in Melbourne in the mid-50s. So that's a massive climb.
It's got about 76%, I think it was.
And it's been like this every week. It's been climbing and steady out every week.
Okay. Spring sales are coming up, and that's a big time for a business like yours. And they've been saying to us that the supply of housing is part of the reason why this house price uplift has come. Are we seeing more listings coming through for spring sales?
Well, luckily for us, we've been on a very strong advertising campaign, and so the C21 stats that I looked at in the last 2 months are actually
the
opposite.
New cool and groovy, rather than Century 21, you're
C21 now, yeah, Peter.
I've seen it.
I can't say the word
impressed.
Century 21. No, C21, and the stock levels have climbed in my organisation, but we have been on a very, very intense marketing campaign, sponsoring different programs and so on. But that level of stock, and you've got buyers in the 20s and 30s in terms of couples turning up to open for inspections. So you've got an abundance of buyers, you've got a low level of listings, and then you've got the issue with responsible lending. And so that's really hurting a lot. So if there is a listing out there for sale and you've got somebody who can borrow money, they're going to pay a good price for that property.
Okay, well, you brought up the subject of responsible lending. To me, it was irresponsibly, aggressively too tough. And now, is it becoming sensible lending now?
Not yet, but I sent an article to you, and the heading was, is responsible lending irresponsible? Because if you can qualify to buy a home at, say, a 3.5% interest rate, but the bank then says, no, we're going to qualify you at 6%. If you can't afford 6%, we're not going to give you a loan at 3.5%. You've got a whole bunch of people out there that are paying more in rent that could be owning a property because of it. And it was even harder a few months back. It was up in the 7.25 that they were qualifying you at. So they're back down to around 6. They really need to adjust that because they're going to affect the housing market very, very badly if something isn't done.
I guess the people who worry about the boom being excessive would say, well, that might keep a lid on this improving market. You wouldn't want the madness of this 2015 16
No,
to come
absolutely
back.
do not.
All right.
Yeah.
But would an increase of supply of houses coming to the market be a sufficient lid on price rises?
Yes, but the problem with stock not coming on the market is people who are selling can't find something to buy. So that's where you get that imbalance. But my biggest concern is the fact that there are people that are being stopped from borrowing, and this is because a certain few got into trouble. It's always the same thing. I mean, I was entrepreneurial with my buying. If I could borrow 100%, I would. I took the risk. I never blamed the bank for anything that went wrong. And I think people need to understand that if you want to be entrepreneurial in today's market, it's very hard. Equity is no longer king.
All right, so let's go around the country. Brisbane, southeast Queensland, what's happening there?
Yeah, the clearance rates normally are very, very low in the Brisbane market. They were up in the mid-50s in the last few weeks, so they're trending along pretty well. See, the Brisbane prices didn't go crazy, so in that marketplace you can still buy safely there and not worry too much about am I buying in the middle of a boom. Brisbane's still got growth left in it.
Now Perth, even say 6 months ago, you thought you were seeing a bit of a bottom going on, but it seems that bottom's, to me, it seems like it's taking a long time to kick
It
up.
is in certain areas. Some of the agents I speak to there are having the best real estate market they've ever had, best real estate sales market they've ever had.
Well, in the last 6 months? Or
Yeah,
last 3
in the
months?
last quarter. And I spoke to an office in Mandurah down south where all the canals are.
And they had a lot of trouble in
They
Mandurah.
were in trouble, yeah. And they're flat out, absolutely flat out, because there's a lot of stock available coming through those areas, and people with a little bit of money can get down and buy that canal home they always wanted for a reasonable price.
Okay, what about Adelaide and Tassie?
Yeah, Adelaide's steady market all the way through, from the start of the boom through to the finish, and I think that market is going to continue
It's a
to
steady
grow.
state.
Grow nicely. Tassie concerns me. The rents in Tassie, especially in Hobart, if I look back to 2015 when I kept some records on rentals, the marketplace in Sydney has gone slightly backwards in terms of rent since 2015. Hobart was over 38% higher in rents in that same period. So I'm concerned that people are now factoring rental income in terms of their investment instead of looking at capital growth. And so in parts of that great state, they could find themselves in trouble.
Okay, now ACT seems like the best place for investors.
We talked about that.
It does really well for property investors, doesn't it?
And we do. We hate to say it, but when the Labor Party get in, it's always good to buy there because there's a lot more public servants. And we've seen that trend. But Canberra's a great place because you do have a lot of job security there, and I think that's an important part of borrowing. And, that area is a great area to buy.
Okay, and finally, I don't want to ignore Darwin because the Northern Territory is going to be
Darwin's had a terrible time, very similar to Perth, and probably worse than. And I think it's more connected to the Asian economies now than it is to the Australian economy. So there's a lot of changes going there. Still an interesting place to buy in. It's not somewhere, for me personally, I'd invest in right now. If I had a choice between Perth and Darwin, I'd probably go Perth.
Okay, pressure time. The good places to buy, good suburbs to buy for first-hand buyers and landlords. Let's go Sydney first.
Well, in between. So you've got to look in the suburbs in between. We talk about this all the time. They pick suburbs and they go, don't like that suburb, got a bad name. That's where you've got to buy. You look at areas go up to well, Sydney first and foremost. I talk about the area between Darrick, Habersham, Mount Druitt, that spot. You've got the M4, the M7, northwest sector where you buy a block of land for 600,000, but you can buy a home in those areas for the same price. And people
what kind
just
of price
ignore
are we talking about?
You can buy properties in those areas for $550 to $650 instead of buying a block of land. And those areas, if you're smart enough and buy 2 blocks of land together, who knows what's going to happen with development potential in the future with all that infrastructure going on around those areas.
Okay.
And I liken it to areas like Ipswich where people sort of didn't talk much about it. But Ipswich is going through a great cycle right now.
So a corridor, a growth corridor, isn't it?
Buy in the in-betweens. Don't be frightened to go into suburbs where most people talk down.
Yeah, well, I must admit, as a young bloke I bought in Paddington, my father-in-law walked in and said to my wife, this bloke's made a very big mistake. Because Paddington was a shocker of an area in those days.
Well, my first house was in Punchbowl. It was on a main road opposite a railway line. That's what we real estate agents call close to all amenities. Right? And now you look at that area there, that's a very, very strong area.
Okay. Now, let's just talk about what you've done to diversify Century 21. You're in a whole lot of things.
Look, we've expanded the brand. I've taken on the Better Homes and Gardens real estate brand, working with Channel 7. It's a brand with high integrity. And so I wanted to create a real estate company that was more of a an advertising or an entrepreneurial business that offered a lot of services within it. So it's more of a styling type of real estate business where they can talk you through a whole range of things because they have that backbone of Better Homes and
So
Gardens
is the
magazine.
idea, and let's face it, one of the most successful programs on television is Selling Homes Australia. And you probably know the real estate agent there, and he looks like a delightful pain in the butt. And I've interviewed him, I like him. But the bottom line is, they really show people how you can buy a property and enhance value brilliantly. And is that the kind of thing you want to show?
Yes, if you go on the Better Homes and Gardens site, they show you things, they show you what to do. And all of that filters through to the offices. Yeah. So the offices are being very selective as to who we are picking to represent the brand. Yeah. And we've recently started opening offices, probably about 8 weeks ago. And there should be close to 20 offices open by Christmas
those
time.
offices will be called?
Better Homes and Gardens Real Estate.
Isn't it fantastic? Okay, anything else?
No, look, there's lots of things, but you don't play golf anymore, do you?
No,
so we can't talk about
it's
that
for old men.
When I
get old enough, I'll play.
All right, oh, thanks. Thanks.
Okay, that's Charles Tarbey, the founder of Century 21, and what he doesn't know about real estate is not worth knowing.
Okay, great, fantastic.
Thanks.
Well, property prices are going through the roof again, and there's no better man to talk to about that than Cameron Kusher, who is the head of research at Core Logic. And thanks for coming to the program.
Thanks for having me.
Are you so as surprised as I am about this comeback in house prices?
Oh, definitely. I mean, throughout this year, particularly in Sydney and Melbourne, we've been seeing an ongoing improvement. First, the rate of decline was moderating. And then the last 3 months, each of those months, we've seen an increase in values and progressively getting larger. But we've jumped from a 0.3% increase in July to almost 1.5% in both Sydney and Melbourne over the month. So it is very surprising how strong it's been.
Now, Cameron, you've seen the experts saying an interest rate cut will not have this kind of impact. Do you reckon it's the interest rate cut only, or is it interest rate cut plus APRA easing up and letting banks lend again?
It's a combination of both of those. Obviously, the interest rate cuts by themselves mean that people that are struggling could reduce their mortgage repayments. But I don't know that they make that much difference without those changes from APRA, because everyone was being assessed on their ability to repay a mortgage at 7.25%. No matter where interest rates were, it's not really going to bring more buyers back into the market. But the fact that that was eased off, that's really, I think, that the combination of those two things has really been the driver of this recovery. But even still, I'm quite surprised that we're seeing almost 1.5% monthly growth.
Okay, and I've been trying to piece together the reasons why a market's gone from being so pessimistic to so optimistic. What's the history of house prices and pre-election periods?
You usually find that property prices before an election do go quiet. Probably not so much in every city, but certainly in Canberra, in Sydney and Melbourne. And I think particularly this election, there were some pretty big changes on the table.
Yeah.
So particularly around the investor space. So for investors, obviously there was talk about changes to negative gearing and the capital gains tax discount. And I think everyone was expecting that there was going to be a change of government. So potentially some of that fear was actually priced into the market already. Yeah. And then when we had the election and there was no change in government, those policies weren't going to be changed. I think that that started off the improvement in sentiment. Then you got a couple of interest rate cuts. Yeah. That improved sentiment further. We also got APRA flagging that they were going to make these serviceability changes. Then about 6 weeks later, they actually happened. So I think those three factors combined have really helped improve sentiment around housing.
Also, I guess you would have been a pretty professional observer of what the media can do. Now, I can remember getting my most scared when I think it was 60 Minutes featured a 40% fall in house prices, and every other media outlet sort of piled into it. Yeah. Do you think the level of media coverage also added to the negativity and explained part of the house price drop?
Yeah, certainly. I think media, as a rule, generally, bad news sells, good news doesn't really sell. So the fact that was out there were quite a few people talking about this massive drop in housing prices. I mean, we follow the economy a lot more than other people. The average punter out there on the street does get their news from 60 Minutes and from headlines on web portals. So when they see that, they start thinking, well, I'm not going to buy a property if it's going to fall 40%. So it does have an impact.
Okay, so I thought that with those changes, I would see house prices starting to sneak up, but they've come up, and I didn't. I actually said to someone today, I still believe house prices will recover, but I doubt whether the western suburbs of Sydney will have a median price of $1 million anytime soon. Because that would seem to me, that was like gee, this is a really big boom. Do you agree with that scenario, or at the moment are you even questioning that?
Well, at the moment we're certainly questioning it. Our view was that the recovery would be a slow and steady one. And you look at Sydney, it's still 13.3% below its peak. Melbourne's still down 9.5%. So it's still got a long way to go, but if we continue to grow at 1.5% a month, it's not going to take long to get there. So I still think it will slow down a little bit from here, because one of the big drivers we've seen over the last couple of months is the buyer pool has really grown, but there hasn't been a lot of stock actually coming to the market. Now we've hit spring, we're starting to see the number of new listings ramping up, and that's really going to tell us a lot about the depth of the market. If we see listings really rise and sales still quite strong, then I think there's some depth to this recovery, but there's still some questions about that. And if we see a big surge in stock, we may actually find that there's not quite as many buyers as we thought. It's just the case that for the last couple of months, there's been no stock and everyone's suddenly got this burst of confidence.
So in many ways, there could be, and it's only guesswork, an opportunity for someone to sell in spring and maybe wait until autumn or the next spring and actually do well out of buy and wait.
Potentially. I mean, we're not expecting that the market's going to reverse again and we're going to start seeing price falls, but I don't think that we're going to continue to see 1.5% growth per month. And I think realistically, the Reserve Bank and APRA, that's the last thing that they want to see. So I wouldn't be surprised if we continue to see the heat in the housing market like what we've seen last month, that they maybe start talking about some macro-prudential policies to try and limit the growth once again.
Let's go around the country, mate. So Queensland and Brisbane were seen as being the state that needs to catch up, and are you seeing any positive signs for Brisbane and Queensland generally?
We've seen a couple of months of increases in values in Brisbane, 0.1% in July, 0.2% in August. So it's nothing really to write home about, but we were seeing values fall. They fell by about 2.5% from their peak, and there's now signs that it's recovering. Brisbane really faces the same challenges as anywhere outside of Sydney and Melbourne does, and that's that the unemployment rate's much higher, the jobs market's not as strong, and there's just not as many drivers of the economy as there are in Sydney and Melbourne. So yes, property prices are very cheap compared to Sydney and Melbourne. Yes, more and more people are moving to Queensland, particularly from New South Wales, but I still think it's going to be a slow and steady recovery, mainly focused on that southeast corner of Queensland.
Okay, let's go to WA, where Perth seemed to have been in a property funk ever since the mining boom went off the boil. Any signs of improvement there?
There are some, I won't say improvement, but maybe the market's not quite as bad as it was. And what I mean by that is values are still declining. We still saw a 0.5% fall over the month, but what we've seen really over about the last 6 months is the magnitude of those monthly falls is gradually slowing. So still declining, unfortunately, for homeowners in Perth, but not declining as rapidly. So that could be some early signs that things are starting to improve. If you look at the demographics, a lot of people have been leaving Western Australia. You have seen commodity prices rally a little bit over the last couple of years, and we're starting to see that outflow of residents from WA slow. It's still losing more people than it's gaining, but not to the same quantum as it was previously. So that will lead to a bit more demand for housing over time.
Tassie has had a great run. Is it still going well?
It is. So we saw another 0.5% increase in values in Tassie, or in Hobart rather, over the month. Regional Tasmania is still growing. It'll be interesting to see what happens from here in Tasmania, because the big driver of Hobart in particular was that it was so much more affordable than all other capital cities. It's no longer the case. You know, wages are actually quite low in Hobart. You've got a higher rate of retirees in Hobart and Tasmania as well. And if you look at the cost of housing, I mean, it's getting up close to the same price as Brisbane. It's more expensive than Adelaide, more expensive than Perth, more expensive than Darwin. So it doesn't have that affordability advantage of other areas, but it also hasn't seen the supply response like what we've seen in Sydney, Melbourne and Brisbane over recent years. And there's still just not a lot of stock actually available for sale. So that shortage of new supply and the shortage of stock actually available for sale is one of the things that keeps driving that market higher.
And being a tourism town as well, I think the costs are going up in Hobart. 'Cause I know someone who retired from Sydney, did well going to Hobart. He's now finding it so expensive and so hard to get into a restaurant on Friday and Saturday night. He's moving to Launceston. He's actually moving within Tasmania.
It doesn't surprise me. I mean, and if you've gone down to Hobart anytime soon, actually even just trying to get a hotel room, I mean, you pay $350, $400 a night for fairly basic accommodation. So probably maybe going to go through some of those growing pains that we saw in Perth, where the cost of living actually became so restrictive that yes, the wages might have been good in Perth, but people weren't as willing to go there. In Tasmania, you know, yes, property's still relatively cheap, but if the cost of everything else becomes very expensive, then it loses its appeal somewhat.
Yeah, just quickly, ACT?
ACT, 0.8% increase over the month, so still growing there as well and accelerating. So not quite to the magnitude of Sydney and Melbourne, but certainly improving.
It's been great for property investors there, hasn't it? And what about Adelaide? It always seems to go about 2 or 3% a year. Is that about right?
Yeah, Adelaide's the non-volatile market, never really booms, never really busts. It's still falling slightly, but again, the last couple of months, the rate of decline in Adelaide has slowed, and I think we'll see that market turn around.
Finally, Darwin.
Darwin really still struggling. Values down 30% from their peak, still falling. Much of what we said about Perth is applicable to Darwin, and it's probably a little bit worse in Darwin because people are more inclined to go to Darwin for work and then leave as soon as that job's over. So you don't get that stickiness of people staying there.
The funny thing, as I'm listening to you, Cameron, I've often said to people when they say, "Oh, bubbles will always have to burst," and I said, "Well, with a balloon, as long as you don't tie up the end, you can let air out." And that's what actually has happened. The air's gone out of this balloon, and now someone's breathing it back in. It's probably lower interest rates and the fact that banks are lending better.
Oh, I think that's a great analogy. So, I mean, I don't think anyone would argue that Sydney and Melbourne aren't expensive, but that doesn't necessarily mean that they're going to bust, particularly when the unemployment rate's below 5%. Most of the jobs are in those two cities. There's huge amounts of demand for housing in both of those markets.
If anyone wants to see the full data in detail, where do they go?
They just go to corelogic.com.au and go to the news and research section, and that's where all our information is.
Great stuff. Cameron Kusher from CoreLogic. Thanks for joining us. Well, that's our first Switzer TV property show. Thanks for joining us. Don't forget to press the like button and also subscribe.